The Federal Reserve came out this week and cut rates, and then what happened to rates inside of real estate? They shot up. WTH, what's going on? Everyone wants to know why things are changing in mortgages. If rates went down from the Federal Reserve, why did mortgage rates go up? So the Federal Reserve cut by 25 basis points, and everyone wants to know what the heck is going on. Let's break it down for you here today. The Federal Reserve set its Fed funds target rate to range from 4.25 to 4.5%. This 0.25% cut is its third rate cut this year. The thing I want you to understand is since the Fed started cutting rates, the 10-year Treasury is up almost 100 basis points. And the 10-year Treasury is what all debt follows here in the real estate industry. So if you want to know what's happening with mortgages, we simply look at the 10-year. As you can see this year, the 10-year Treasury was trending down, and the Fed was getting ready to do its second cut right here in September. And as they did their second cut, rates started shooting up. Rates started calming back down. The Federal Reserve does their next rate cut, and rates shoot up again. The question is why? Why is this happening? The market doesn't like what they are seeing. Core CPI 3.3, core PCI 3.5, core PCE 2.8. All of these inflation metrics are higher than the Fed's preferred target rate of 2%, with core PCE being their preferred metric. Jobs came in at 227,000 jobs, slightly higher. Right here, we're looking at the dollar index. You could see it was mirroring the 10-year Treasury. It was trending in a downward direction. Boom, first rate cut. Starts to trend down again and then shoots and almost hits a session high. So look at that. We were only just this high, the dollar being worth that much back in 2022 when we went through that massive rate hiking cycle. GDP for second quarter came in hot at 3%. And looking ahead, the Federal Reserve Bank of Atlanta, their GDP estimates are now 3.2% for fourth quarter of 2024. So what is the market saying to this? The market is saying maybe this was our last hurrah of rate cuts. The Fed didn't want to shock the market. The Federal Reserve had already telegraphed that this specific rate cut was coming. So it was already baked in. The CME Fed Watch tool said there was over a 90% chance that this was going to happen. So Papa Powell, Jerome Powell, did not want to basically undermine the confidence of the markets by doing something different. But the problem is all the economic data was coming in better than expected. And because it was coming in better than expected, even though the Fed cut rates, the market responded negatively. And as the market responded negatively, the dollar rose and then bond yields went up. A big takeaway here is that investors appear to be less focused on the Federal Reserve's interest rate cuts, and they're more focused in looking at the solid economic data and inflation trends. The Fed now sees employment staying in the low fours throughout 2025. They see that we're only going to end up with 2 rate cuts, so they've brought that number down. So the Fed is projecting now in their summary of economic projections, higher GDP, lower unemployment, therefore less rate cuts are needed. So the market responded negatively, pulling up rates. What does this mean? One, the Fed did their little happy dance, and Jerome Powell said inflation is still broadly on track. He was basically claiming a victory lap, like they had hit the soft landing. The summary of economic projections is projecting that uncertainty is lower, but the economy is performing better than expected. But some people believe that some of this data is actually worse than what we're seeing out there in the news and being reported by the government. Let me know what you think about the data. Do you think the unemployment numbers are reflective? Do you think that the economy is doing as well? See, because when I talk to the average person, I believe they're feeling a little more beat up. So if it stays the way it is, rates will stay higher for longer and will most likely be in the high 6s to mid 6s. But if this economic data starts breaking like it could, then that will start to bring the numbers down into the low sixes and maybe, just maybe, the upper fives. But what's happening is the market, because it's a forward-looking indicator, is essentially telling us that they do not agree with this specific rate cut and that rates need to be higher for longer for a period of time. Hey, if I missed something, hit me in the comments. As always, hit that subscribe button and share this with someone else who needs to know this.